number one, you're Colton, Chief Technical Officer, co-founder of Hedgehog.
Technology officer.
Oh, what did I say?
Technical officer.
Oh my God, horrible.
Yeah. Perfect.
Give us a little bit about maybe your background with Acorns and how did it evolve to Hedgehog?
Certainly. So actually, not only am I the Chief Technology Officer of Hedgehog Technologies, which is our parent corporation, but I'm also the Chief Compliance Officer and the Investment Advisor Representative at Hedgehog Advisors, which is the actual entity that advises you and gives you cryptocurrency investment advice. And so, a little bit about me. I went to university at Northwestern for theater, and then immediately got my graduate degree in engineering design and innovation, because I had a weird sort of deal with the administration where if I took all the engineering classes, I could go into the grad school because the College Board doesn't endorse degrees in theater and engineering. And so I had to sort of create that myself. But while I was at Northwestern, I started financial engineering. And of all things, my voice teacher in high school taught me how to trade derivatives, because he was an instructor for eOption or some website in the 90s. And so one of my first jobs out of school ended up being at a company called Acorns, where I was employee number 5. I originally joined as their chief marketing officer, and through the vicissitudes of startup life, I ended up becoming a Series 65 investment advisor representative of the advisor subsidiary at Acorns. I helped set up the advisor and the broker-dealer. I eventually connected with a group called In Street Investments out of Australia, and we helped set up Acorns Australia with them. So I was in charge of sort of the global operations program and trying to set up different regulatory regimes around the world. And, what was Acorns Australia turned into what is now Raise Invest. And Acorns itself was valued at $1.9 billion last year. So it was a good time. We learned a lot. I helped acquire the first 2 million app downloads while I was the chief marketing officer, and then transferred into the global director role. And after that, I went into business with Taylor, my co-founder and our CEO at Hedgehog, where we were doing sort of startup consulting. And we had 1 month where 3 of our contracts, all 3 of our clients all broke their contracts in the same month. And so we were looking around for ways that we could avoid that in the future. And we learned about automated escrow contracts on Ethereum. And so, a light bulb went off, and we decided to start investing more time into learning about cryptocurrency. And, we were trying to manage our portfolios in spreadsheets the whole time. And it was taking days just to figure out where everything was. We read a survey that said 60% of people in cryptocurrency at the time had 3 or more exchange accounts, because that was the only way you could get access to all the different currencies, was to open up accounts on multiple exchanges where there was liquidity. And so obviously managing that takes a lot of time. And for that reason, we started building Hedgehog to really make that easier. And really try and apply some of those lessons that we learned at Acorns to our experiences investing with cryptocurrency.
Awesome. Shout out to your voice coach. Starting
Gustavo
you down
Guzman.
the path.
Gustavo Guzman.
Nice. Excellent. I love that. That's awesome. And I love the story. It's very cool. And, I think one of the things that has stuck out to me instantly is that you are able to give financial advice where other people are not. What is the mechanism that allows you, Colton, to give financial advice when it comes to cryptocurrencies?
Yeah. So in the United States, obviously, investment advice is regulated by either the state that you're offering investment advice in, or in the case of offering interstate advice on the internet, the SEC directly, the Securities Exchange Commission. And so we have registered with the SEC, which, registration is not an endorsement. It doesn't mean that you have any particular skills. It just means that the SEC knows about you and they can find you if you're doing naughty things. But that's an important process, is to register with the states, register with the U.S. Government regulatory bodies, and to allow them to find you. So because we do that, we can charge clients to give investment advice. And generally we can write investment research and sell that research for money, which, if you are not registered, then you should, if you're doing any of those things.
Awesome. So as far as Hedgehog goes, like, what kind of advice does the user get from Hedgehog?
Yeah. So, one of the things that we really wanted to stress when we first started looking into cryptocurrency and thinking about ways that we could make it easier for people was really just making the research available. There are over tens of thousands of currencies that are actively traded around the world, and trying to find information about which wallets are legitimate, who are the people who are contributing to the cryptocurrency, who are the developers, who own the foundation, what is the actual organization, where is it registered, what business partnerships do they have. These sorts of things can be very difficult to find. And so we wanted to create sort of one big repository for that information, which is what we started with at hedgehog.app, our website. And now that we are registered with the SEC, we can actually start take discretionary control over customer accounts. That means that you have an agreement with us that says we can trade on your behalf, and you give us discretion to trade with a certain amount of money. And so we can actually assemble a basket of currencies for you and then trade into them automatically based on whatever metrics you think drive the success of the cryptocurrency. And so, if that's market capitalization, like the S&P 500, where, you're just trying to buy whatever cryptocurrencies everyone else is investing in and trying to hold them into the proportion that everyone else has invested into these cryptocurrencies, or whether that's more fundamental metrics like daily unique active addresses, daily transaction volume, mining fees. These sorts of things are ways that we can automate your portfolio and slowly allocate funds into currencies as their performance changes. And so we like to say, if back in 2004, you could have invested in Facebook, MySpace, and Friendster, but instead of investing in them just off of a gut feeling, you could invest in them based on their daily active user metrics. Well, then you would have kept putting more and more money into Facebook over time and less money into MySpace and Friendster. And you could have caught that wave as it started to build. And so we're trying to do something very similar with cryptocurrency, where we can expose these fundamental metrics and you can track your portfolio using those metrics.
And that really leads us to the rebalance feature as well. So we have these stacks of cryptocurrencies, and those are chosen based upon the metrics you just mentioned. What goes on behind the scenes when someone is going to keep a balanced portfolio, as far as buys and sells? Like, what's the actions that separate this product from somebody doing it themselves?
Yeah, well, so, let's say that you as an individual wanted to create a basket of cryptocurrencies and invest in them based on market capitalization, right? So that means that either you're writing a program, or you're using an Excel sheet, or you're taking a calculator and you're going to coinmarketcap.com or hedgehog.app and you're looking at the market capitalization of each coin. And then you have to add all of the currencies that you're interested in together. And then for each currency, you divide its current market cap by the total market cap. And whatever percentage you get it out, you multiply that by the total cash that you want to invest, or the total US dollar value, or whatever numeraire you want to use. And then that's the percentage of your portfolio you should keep in that currency. And so you'd have to do that for each currency that you want to track in your coin. And then you'd have to figure out what custodian supports that coin. So, let's say that Coinbase has a currency that you want to invest in, and Gemini has another currency that you want to invest in. And then Binance US has a different currency that you want to invest in. So you'd have to open accounts on all of those exchanges with all of those custodians in order to get access to those cryptocurrencies. And so, it's a very manual process. It takes a lot of time. With Hedgehog, we're trying to take all of that stress out. It's literally choose your basket. It'll have all the currencies listed for that basket. It'll tell you what strategy it's using. If you want to change that strategy, we'll follow whatever directions you give us, and we'll automate that so that, if you have a monthly rebalancing schedule, we will make sure to rebalance your portfolio according to that strategy each month. And you don't have to get out the calculator to do that.
I like the sound of that. Who do you think the typical cryptocurrency investor is? Like, who, in your opinion, is the right kind of investor in cryptocurrencies?
Yeah. So, there's a wonderful survey that appeared on Reddit where they went to all of the major cryptocurrency trading subreddits, and they asked people a variety of questions. And one of the questions was what was your first investment? And 55% of respondents said cryptocurrency was their very first investment. So, people like to think that it would be stock or, maybe bonds or something like that. But a lot of individuals are getting their first taste of investing today through cryptocurrency. And they view it as an exciting asset class. And obviously the returns over a long enough time period have reflected that it is something worthwhile in investing in, as long as you can handle the volatility. And so what that means is that while the average investor of cryptocurrency is probably young, in their mid-20s, probably male, the appropriate investor is anyone who has a long time frame, who can be aggressive with their funds, who don't need to maintain the value constantly, who aren't looking to withdraw immediately, and probably who have some savings in the bank. So you're not relying exclusively on cryptocurrency. Hopefully you've got 6 months of expenses in a bank account somewhere. And then after that, you can start investing in crypto. A lot of traditional investment advisors say that, about 5%, 1 to 5% of your portfolio should be cryptocurrency. But we really view it as an asset class very similar to emerging markets, where, if you have a very aggressive portfolio, then you can allocate, up to 20% to crypto, 30% to crypto. But if you're looking for something more stable, then you have to choose other strategies within cryptocurrency, like looking at stable coins. The SEC has come out against a lot of yield farming as unregistered securities trading. So, do that at your own risk. But there are ways to assemble a cryptocurrency portfolio that can take advantage of some of these more stable aspects of the sector.
Awesome. When it comes to the stacks products and rebalancing, is there a traditional finance product that this closely resembles, or a strategy that is used in traditional finance?
Yeah. So, traditional robo-advisors tend to use what's called modern portfolio theory. And essentially the way modern portfolio theory works, it was invented by a guy named Harry Markowitz, who I got to work with while I was at Acorns. And so he actually endorsed the methods that we used. And so essentially what you do is you look at the excess return of any individual currency over the risk-free rate. And what that means is essentially we're saying how much extra return can we get by investing in this asset versus just putting it in like a government bond, where because the US isn't likely to go out of business in the next 30 years, we can put our money in a US Treasury bill and we can get a certain amount of return. What is the additional return that we can get from investing in this asset? And then over that period of time, how much did the performance fluctuate? What was our risk? And so by comparing the excess return to the risk that we took, we can get a number out the other side called the Sharpe ratio. And we'll see that in general, riskier assets will have higher excess return. In general, less risky assets will have lower excess return. And you can actually plot this on a graph in what's called the efficient frontier. And an ideal modern portfolio will sort of choose assets across this efficient frontier, and will give you some additional performance for whatever risk profile you're looking to accept. So, if you want to keep it low risk, then we'll move you more to the left on this efficient frontier. If you want to take more risk, then we'll move you more out to the right.
It's interesting too. You mentioned that someone who would be more suited towards the cryptocurrency investments would have kind of like a longer term time frame. Like in your opinion, what's that range look like of the amount of time?
Yeah, well, so past performance is no guarantee of future returns. Got to give all of the disclaimers. But if you look at the history of cryptocurrency, it goes in about 3-year cycles, right? And so if you want to withdraw in the next 3 years, then cryptocurrency may not be the best investment for you, because it might drop 80% and then you'll have to sell at 20% the value you started with. But if you're willing to hold over a longer time frame, then you can wait for some of those fluctuations to actually withdraw your currency. And even despite the recent crash, if you back out more than 3 years, the performance of cryptocurrency has been quite good. And so, some of these shorter time frames, it may not be appropriate for you to have a full cryptocurrency portfolio. But for longer time frames, it's definitely worth considering as a way to improve your returns for the acceptable risks.
There's been a lot of, even despite the state of affairs right now, there's still a ton of institutional money coming into cryptocurrencies. Why do you think that is? Or what do you think the reasoning behind that is recently?
Well, I think that the institutions see the same things we do, right? That young people are getting started with cryptocurrency. They're an exciting asset class, similar to technology, in that there are a large number of stinkers and a small number of winners. And they want to participate in the growth of that asset class. And, they have customers just like everyone else, and their customers are saying, hey, I want to invest in cryptocurrency. I want exposure to Bitcoin. I want exposure to Ethereum. And so, it makes sense for these large institutions to get involved. And their risk management teams may have a lot more experience than some of the new entrants into the cryptocurrency market. And so they'll be more wary and take fewer risks. But, they want to be a part of this new asset class and to be able to provide that for their customers.
You mentioned the technology, which brings up like a question I have all the time. We have cryptocurrency on one side, which is like the investment driven mechanism, but then we have blockchain on the other, which is the technology mechanism driving everything. Like, what is it about blockchain and the way it handles data that makes it so unique from software we've had before?
Yeah, so basically there are 3 key things in the design of these systems. It's called the crypto trilemma. And instead of a dilemma, there's 3 things to consider. So do you want decentralization? Do you want security? And do you want throughput? Right? So these things are all at odds. How do we include more people, get more transactions into the process, but how do we make it more resilient to failure if someone wants to shut down our server, or if we have a storm that shuts down the power on our server rack? And then how do we make it secure? How do we make it resistant to people trying to destroy what we've built or to fake transactions? And so, blockchain is a really exciting application of that. Blockchain isn't actually the only technology in distributed ledger technologies, which is the umbrella term. It's just one of the more recent innovations from Satoshi Nakamoto, who was the anonymous individual who released a paper in 2008 describing the Bitcoin protocol. And so what's exciting about it is that now we can go from, I have one server and I'm registered with the government and they tell me that we're going to give you an audit every now and then to make sure that you're not lying to your customers. And we can say, hey, everyone's an auditor now. We're going to publish all the transactions to everyone who wants to participate in the network. And we're going to essentially hold a lottery that says one person gets to record transactions for the next 10 minutes. And, we're going to pay that person to include our transaction first in the block. And they'll also receive a reward for just participating early on in the life of the network. And so this lottery essentially gives an individual a way to write in the ledger and then have a low chance that they get to write in the ledger a second time in a row. Because if they are the one who is creating the ledgers twice in a row, then they can predict things about how the money is being spent and where they can send the money and perhaps reverse a transaction from the previous round. And so by running the Nakamoto consensus, the Bitcoin protocol, we can actually probabilistically say that it's very unlikely any one person will be able to write multiple times in the ledger in a row and that they'll be able to cheat someone. And so because we have this guarantee that we have all these people who are looking at the ledger and making sure that nobody's cheating, now we have verifiable history in a very fuzzy way. Right? We know that there are a certain number of blocks since the original block in 2009. And so you can timestamp things, you can order things in history, and you can make sure that people only spend money that they have because everyone in the group is sharing the ledger and watching each other to make sure that they're being honest.
So, the person who writes the block gets, a portion of a reward for winning the lottery, but then there's validators, the people who are auditing this. Like, what is actually happening when basically a computer is participating on the network auditing these transactions as a validator? Like, how do they make money and what are they actually doing?
Yeah, well, so validators, there are two systems, right? There's proof of work and proof of stake. Really, in proof of work, which is what Bitcoin uses and what Ethereum used to use before the merge, everyone is a validator. You don't accept the block that somebody broadcasts unless you verify that the block is valid. So, essentially you can string all the blocks from the beginning end to end. And part of the process of choosing a valid block is that the block meets a difficulty, which essentially means that in order to compute a valid hash, a hash is, we have a bunch of information and we can chop it up and put it together into a string of digits. And so if you've ever seen the block hash, that string of digits is just a compressed representation of the information that was included in the block. And so what we're going to do is, in order to compute a valid hash, we have a certain amount of difficulty, which says that the hash has to start with a certain number of zeros. So, if I compute a hash of all the transactions I want to include in the block, and it doesn't start with 6 zeros, then I have to recompute the hash by putting a new piece of information into it, which is called a nonce, or a number used once. And so essentially, for each of these blocks, you can string them together and you can count the number of zeros on them. And whichever string is valid and has the largest number of zeros, that is the one I will consider true history, because it means that on average, the largest amount of computing power was used to compute the hashes that went into that block, because people kept having to try to produce a valid block, and they kept using the cycles on their computer to say, nope, this didn't work, next one, nope, this didn't work, next one. And that's how the lottery works, is essentially whoever computes that string of zeros first, they get to write the transactions down, and everyone accepts their block as the new valid block. And if you change any single thing, any transaction, anywhere from the beginning of the history in Bitcoin to now, then you won't get a valid transaction anywhere after that change. You'll have to compute all of the blocks since the change that you wanted to make to the currency, since the change you wanted to make to the ledger. And so, that makes it very difficult to rewind, go back in time, change something, and then benefit from the change that you made.
So if you wanted to change something in the past, you would have to have computing power or something strong enough to change all the blocks preceding it, in a sense. So
Exactly.
that's what makes it secure. Okay.
Yeah.
That makes sense.
And you can actually, there is a website, I think it's called 51% or something, but it'll tell you how much it costs to run that much computing power in order to lie to the network for an hour. And so I think right now for Bitcoin, it's something like 50 million or something per hour if you want to lie to the whole network to run that many computers.
Oh, so let's say someone did have the 50 million and they could lie. Like what even benefit would they get from that?
So it's like counterfeiting money, right? So now I can go to you, and if you want to sell me something, I can say, will you accept half a Bitcoin? And so you say, yeah, I'll accept half a Bitcoin, and you send me the object, and then I go back and I rewrite the chain so that I didn't send you half a Bitcoin, I kept that half a Bitcoin. And so now what do? The chain is whatever the longest set of zeros is. And so if I was able to, hide how much computing power I had and then release a valid block ahead of everyone else, or a string of blocks, now I can undo that transaction. And so, probabilistically, if you believe that, 49% of the validators, 40% of the validators the miners, 40% of the miners are dishonest, then, you should wait about 4 days before you accept a transaction, because 1 in 1,000 times they'll be able to rewind the chain. But if you believe that, only 5% of people are dishonest, 5% of the computing power in the network is dishonest, then you can accept a transaction within 30 minutes. And you can believe that it's very unlikely that that's going to be reversed.
So even in this scenario, if someone was able to do this, eventually, the data wouldn't match up and it would be found out anyway.
Exactly. And so it's just a question of whether they can execute their scam in the period of time that they have, that they want to spend the resources to run that compute.
Gotcha. So it's it's a behavior mechanism, really. A lot of it, the reward system for people participating. So, and that kind of fills in some other gaps for me too. The more people competing for this lottery, the more secure the network is, because the larger amount of computing power someone would have to compete against everyone at once.
As long as you believe that everyone's honest and no one's going to form cartels, which, it is a possibility, right? If China were to say to all the Chinese miners, all right, for the next 2 days, you're all going to work for us. That's not outside the realm of possibility. But that's why decentralization is so important, is that we can resist some of these possibilities that government actors or malicious cartels can influence the network.
So when this person wins the lottery, there's a mechanism that says this person gets compensated by a certain number of these coins. They get a certain number of Bitcoins, and it's already written out to know how many total coins will be written in the life of Bitcoin, correct? 21 million. And so when we talk about a halving event, that basically is saying we're slashing in half the reward that person gets for writing the next block, right?
Exactly. And basically, that's just a built-in mechanism where early on, it's hard to convince people to run their computer 24/7 on something that might not make them very much money, right? When Bitcoin was first started, the price per Bitcoin was, less than $1 for a whole Bitcoin, and now it's $22,000. So, in order to incentivize those people to take a gamble that the Bitcoin network will actually become huge, they started out with large rewards for these early adopters, these people who are willing to give up the electricity bill that they pay to run their computer and the computer that they could use to do anything else in the world to instead, validate transactions on the Bitcoin network. And so over time, hopefully, as the network grows and more people value the currency on the network, then it's not as necessary to give those rewards back to the miners. And so we're slowly going to taper off how much of a reward we're giving until hopefully in the future, just the transaction volume on Bitcoin alone makes it worthwhile to run a node and to keep the network secure. Now, there's some argument over how true that is, and you can view the price per hash over time, and you can see that it does fluctuate, and it hasn't been as exponential as we'd hoped. And so there are some problems to be solved for Bitcoin over the next 70 years before we get to the end where we aren't issuing rewards anymore.
So let's pivot to Ethereum. So Ethereum had the same, what we would call a consensus mechanism that rewarded people for mining, and it's switched to a proof of stake. How does that mechanism reward people for participating?
Yeah, so the structure is a little different for proof of stake. The way Ethereum is set up is essentially they divide the blocks into epochs, and essentially in an epoch, things are configurable, right? It's a little bit customizable and malleable. We're going to elect 128 committees of miners who are all going to propose one person to write into the blockchain, and they're all going to, scrutinize the 128 people who are proposed. And for anyone who finds someone proposing invalid blocks or hashes, everyone puts up a stake, right? They say, okay, I want to be a validator. I'm going to put in 32 Ethereum into a pot. And if you catch me lying, then you can take some of the Ethereum that I put up. And for everyone who agrees to this structure and who spends time reviewing other people's transactions and taking the risk that someone might steal some of their currency if they made a mistake or if they weren't connected to the network, Ethereum rewards those people with an inflation rate, which right now I think is about 8%, is what you can earn if you're running a mining node for Ethereum. And so, that's the risk, right? Is someone, maybe you have a bad internet connection or the power goes out, you're not connected to the network anymore. They'll take a little bit of your stake because you're not checking in. Or, if you process a bad transaction, you had bad code on your machine, they might take a little bit of your stake. But the reward, if you participate and if you continue looking for bad actors, is that you get that inflation.
So in this scenario, there's, how many did you say, 28 or?
128 committees, and each of those
128.
Yeah, and each of those committees, I think, has I don't remember how many validators, but you end up with thousands of validators, and the likelihood that any majority will be randomly sorted into the committees is very, very low, like 2 to the negative 48th power or something. And so, one of the nice things about proof of stake is that as long as people are checking the transactions, you only need 1/3 of people to be honest. 2/3 of people can actually be dishonest, and you can catch them and announce to everyone else that bad stuff was going on. But the flip side of that is people have to check, right? It's not part of the protocol that people who accept the valid blocks are validating them. People can just sort of assume, and there's nobody to warn you unless you're listening and checking. And so, there are trade-offs. And that's why one protocol may be more valuable or may get more adoption than another protocol. And that's part of why we're interested in, holding a large basket of them, because, you never know when the next cryptocurrency protocol is going to turn out to be way better than Ethereum for whatever reasons, and just take all the adoption.
So would you say that a lot of these projects, projects versus companies, crypto projects, are essentially like mini startups themselves? A lot of what they are going to do is yet to be seen.
Absolutely. And not all of them do the same thing, right? One of the nice things about protocols that support smart contracts is that you can have a business or a protocol built around doing something very specific. So Chainlink, what they do is they have a protocol where people can vouch for real world information. There's a problem in computer science called the Oracle problem, which says, how do I know what you're telling me is the truth? At a certain point, unless I am creating the information, I have to trust someone to tell me what the truth is. And we have to come to agreement about what the truth is by consensus. And so what Chainlink does is it essentially allows people to put up a stake, and people can validate that the information they're providing is true, or at least references some real world value. And if people find that this is false, there's a way to report to the network that this person is being a bad actor and reporting false information or lying. And so, Chainlink is a perfectly wonderful application that people pay good money to use, and you can own a piece of that protocol and experience price appreciation as more people have demand for whatever currency is available. So it's just like any other product out there. If Tamagotchis are in high demand, then the prices are going to rise. So if the currency that does a specific thing on the network are in high demand, the price will rise. And so you can speculate that, or you can use it, right? If ideally cryptocurrency creates apps and products that you want to use. Just like there's Dropbox, there's Filecoin, right? Where now I can store things on the interplanetary file system, where computers around the world will store my files for me, and I can get that much cheaper than the storage Dropbox is going to offer me. Or even if I'm technically savvy and I want to store that information on Amazon Web Services. So there's a lot of value that gets created by the cryptocurrency ecosystem that we think people should be able to participate in.
Love that you use Tamagotchi as an example. You're speaking my language. Another element to this is some of the transparency aspects. It seems like I hear people say a lot, you can just check the code, or, there's this large group of, and, anybody can verify that somebody's doing what they say they're going to be doing. For like a normal person or like an average person with average technical skills, like what kind of like checklist, or how would they go about doing something like, let's say, I'll just role play it out for you. Like, I'm interested in a cryptocurrency project, but I don't know a ton about them, and I want to like look into them. Like, what are the steps somebody would take to feel better?
Yeah, obviously you want to look at the reputable sources in the cryptocurrency world for, are they supported on some of the largest platforms like CoinMarketCap, or, on Hedgehog, we try and produce information about each of these coins. And so like, that's number one, is just, are there other companies who I know and trust that already know about this protocol and know about this chain? Are they supported on the largest exchanges like Coinbase, Kraken, Gemini? That's probably a pretty good indicator that somebody has done some due diligence, and so you don't need to do the heavy legwork of figuring out what's going on. Sort of the next step, if you want to go a little bit deeper, besides just reading the materials that other people have published on it, is you can actually go to the website and look at their documentation, right? Does it look like they actually care about the community of people who are building on their platform? most of these projects will have an open GitHub, or GitLab or source control environment where they store their code. So even if you don't know how to code, you can go to that website and you can see how active they are. Have they been pushing tests pushing new code every day? Do they have tests written? How many contributors are there on the project? How many people are actively contributing code and developing the project? Another thing you can do is look at the public information about the performance of the chain. So one of the things that we emphasize is, is there transaction volume occurring on chain? Are there daily unique active addresses that are interacting with the chain and, not just like 10 people who happen to be using the network? You can look at who's involved. Do they publish their team? Have they doxed themselves? If they're anonymous, that might be more of a risk. But, there's also things like Yiffy, Yield Finance, where all of their developers are completely anonymous, but it's a perfectly wonderful protocol. So maybe there's a long game in there that it could be a scam, but the longer the coin has been around without anything blowing up or without people getting involved, the less likely that is to occur, now, because they've had many opportunities to scam people of millions to billions of dollars. And so if they haven't taken the opportunity yet, what are they waiting for?
Sure.
So, there's always risk, right? In a new project, there's a reason why the SEC doesn't allow unsophisticated investors, is the term, people who don't have $1 million in net worth, or people who don't earn $250,000 a year, or people who haven't invested before. There's a reason the SEC doesn't allow them to invest in private companies, because you have similar risks when you invest in a startup. Right? Who are these guys? Are they registered with the government? Are they going to run off with my money? Are they going to go vacation in Cancun using the money that I invested in them and then say, oh, sorry, it didn't work? Those are risks, and they're amplified by the fact that people can be anonymous and decentralized and may not even be in your country. So it's important to do that due diligence and to really research who's involved, what's the health of the project, are people actually contributing code, and who else has looked at the project and says, I think it's a good idea to invest.
That's like a very good point you just brought up too, is, as far as emerging projects or companies, access to invest in these types of things is a lot easier with cryptocurrencies than it is in a private organization in the United States. Much easier to hear about, and everyone has the ability to participate. You think that's driven like a lot of the success we've seen already?
Absolutely. I mean, there are any number of people who have given money to their brother, to their uncle, to their friend who is starting a new business. And, that can be risky because the scammers come out when there aren't any regulations, when there's no oversight. And we've seen some of that with cryptocurrency. But the fact is that there's appetite for it, right? People who invest, they when they're just getting started, they often have a mistaken conception of what investing is. They're hoping they can drop in $100 and win the lottery. And usually that's not possible. If you're going to invest in traditional markets that have been scrutinized and registered with the US government, it's unlikely that you're going to get that kind of 1000x return. Whereas with cryptocurrency, if you're sprinkling a little bit of cash into this crap project, you'll lose a lot of them, but maybe there will be one that just blows up by 1000x. Now, this is incredibly unlikely, right? And you want to be disciplined if you're going to invest in that, but invest that way. But, the fact is that you can't just buy a lottery ticket and win, right? There's a reason why the lottery in most states is a losing proposition if you average out the expected value of winning. But that being said, if you do a little smart diligence, if you are investing for the long term, and if you're really being deliberate about the projects you choose to invest in, then I think it can be just as good as any other strategy.
And, just to tie it back into Hedgehog, that's what makes this product so good, right? Is that, there's people have put hands on it, and not only have people put hands on what makes up a stack or a basket of these coins, but they put hands on the calculations of how much goes into each one, right? Like that's the complicated part.
That is the complicated part, and that's what I do. I am your investment advisor representative if you choose to open up an account at Hedgehog, and I am personally doing research into projects, writing the code, and making sure that when we recommend something as an application, that it's not just any currency, that there is some real meat behind it. And we do have criteria for including those currencies in our portfolio. And so, to a certain amount, if you take us on as your advisor, you can trust us to do our job. But it's always even better if you double check us and make sure that the real meat is there, which is why we try and make all of that information public and accessible for our customers.
Awesome. Well, you're a very smart guy, so that makes me feel very good. Anything you want a user or potential user to know about Hedgehog? Any kind of last things you want them to know about?
We've been working really hard on it for the last few years. And I think that when you get the chance to use it, it'll show. Investing involves risk. So do it at your own risk. Make sure you're in a good place to be investing in a risky asset class. But we would love to help you get started with cryptocurrency, to understand what's going on, and hopefully to get involved, because that's really what it's about, is creating the next generation of users of Web3 products, and getting people to benefit from all of the cool things that they can do.
Awesome. Well, I appreciate your time. I know you're super busy, and I think we should do this again.
We should. Thank you, John. I always love talking to you.
All right, man. I'll see you out there.
See you out there.